Is the Australian property boom over, or does it still have legs? In this video, we'll talk about key economic indicators with the context of history, okay? All these new YouTubers, property pundits, experts, media headlines just talk about the here and now, but with that, you can't see the forest from the trees. If you are serious about making money in property, you have to understand context, numbers, and economics. That's exactly what we'll be going through. If you're interested, carry on watching. My name is PK and I help people build passive income through the Property Investment Accelerator mentorship program using data without needing a $15,000 buyer's agent every single time. This channel exists to help you understand three things: property investing, the Australian and global economy, and how to achieve financial happiness. If you're interested in one or more, hit the subscribe button and give this video a thumbs up. Without any more fluff, let's get into this first chart. What you're looking at here is the demand factors or conditions and supply factors or conditions that create or destroy a property boom. Okay, so the context or the source for this is Nucleus Wealth, and it gives us an understanding of 5 distinct property cycles or property periods. One, the boom from 2012 to 2017, the bust in 2018. By the way, the bust was a maximum of 7% downward movement in house prices, so it's not exactly a crash, it's just a small correction. Pre-COVID, COVID, and where we are now, post-COVID. And it goes through the factors. So let's look at them one by one. First thing is credit availability. What created the boom was huge credit availability. Basically, the ability for you and I to borrow money, the bank's appetite. And that got busted in 2018 because affordability was getting out of hand. Too many investors were coming in to the market, and APRA said, the regulatory authority said, this could destabilize the Australian financial regulatory system. And so they said to the banks, you can't lend as much as you could before. Now, the case right now is that they can still lend as much as before. APRA is not tightening things really much at all. And the thing is that this boom is still led by owner-occupiers. Investors are still under 32% of all property purchases, whereas back in 2012-17 it was above 50, right? So this is an owner-occupier-led boom. If you've been following me for years, you know what I've said about owner-occupier booms. They're not bubbles, they're genuine booms. And so therefore this bodes well for continued price growth. Price of credit. Okay, so that was higher interest rates back then, and now it's incredibly lower interest rates. Of course, they're going up or have already gone up, but they're still much lower than what they were back here. And I'll deep dive into that later in this video. Employment, it was pretty okay back then. Right now, wage growth is improving, but from record lows. But this is a big green check for me. Unemployment is at record levels. It's basically below 4%. So lots of greens here as well. Population growth was good back then. It's a question mark at the moment. During COVID, obviously no pop growth from overseas. But in the next 2 or 3 years, you reckon there's going to be hundreds of thousands of skilled migrants coming into this country? My bet is the Australian economy needs them. So that's a huge tick in my book, a huge green, green, okay? Foreign buyers, they were very active back then, but still the number of foreign buyers were very small in the context of total property purchases. Right now, they've basically been discouraged, okay? So that's a negative, but small in context. Tax incentives, pretty good back then, still very good now, and we know that both political parties, LNP and Labor, have said that negative gearing is not going to be taken off anytime soon. So tax incentives are still there. Money laundering, that's pretty constant. That's the demand side. So overall, I'd say the demand side is just as good as, or almost as good as, the last property boom. Now, supply side, restrictive planning, which means that councils are simply not able to build that many houses. That is really a strong thing for property price growth, because once again, even though there's lots of approvals, construction costs and all that kind of thing means hardly anything getting out of the ground. So that restricted supply means prices are likely to continue growing. Under or oversupply, similar sort of thing. I mean, like I said, large amount of building in progress, but nothing's really coming out of the ground because construction costs are a record high. So it's not commercially feasible for a lot of these developers to actually build, even though they have development approval. Restrictive planning, I mean, this is especially the case in Brisbane. The Brisbane City Council, the biggest LGA in Australia, are so terrible at giving approvals. So even if they do give approvals, builders just don't have the feasibility to actually build them. And that means supply is so constricted, so constrained. And structural change, look, back then there was no real structural change. Now there is more desire for houses versus units, more desire for regional areas versus cities. So there is one red here. However, that's pertaining to units in capital cities. So as long as you stay away from them, it's a big green, green, green. So, once again, I always say this, and I don't want to come across as paranoid, but I really don't like this word spruiker, because it means that people are trying to sell you something. Everyone's a spruiker in property, right? But I'm trying not to come across as a spruiker. You can make up your own mind about the health of the Australian property market, comparing it to the last boom for yourself. The level of green right now on this right-hand side is just as much or almost as much as right here, as distinctly opposed to these 3 periods in the middle where prices didn't do as well, especially these two, okay? Okay, well now let's look at 4 key indicators, economic indicators with context: mortgage rates, inflation, wage growth, and rents. Okay, and really so you can understand what's going on in the property market to make up your own mind. Okay, let's zoom in and let's look at this first one. Mortgage rates are increasing even before the official cash rate rises. So they've already gone up. You could get a rate under 2% last year or the year before. Now it's 3.6%. This is the average. Obviously, it's still very low, but the point is, everyone's sort of waiting on the official cash rate from the RBA to rise, which it will, but they've already risen for all intents and purposes. So if you expect the property market to crash when rates rise, well, here's some news. They already have. Okay, so property market hasn't crashed, but there's still record lows. So that bodes, for mine, that bodes really well. They've already risen more than 1% for all intents and purposes, and the market has continued to drive higher and higher. I'm not going to say that this rate of growth will continue forever, but the growth will in many cities, not Sydney, Melbourne. Next thing, inflation. Everyone's talking about inflation, how it's just like so bad and everything like that. Inflation has jumped. I mean, there's, everyone knows about that. However, right, you can see that it's not the first time in history that it's done this. In fact, back in the GFC, inflation was higher just before 2010. Back in the year 2000, or at the turn of the century, it was even higher. So yes, it's high in the context of the last 10 years, but traditionally it's been much higher. Okay, so look, it's not like inflation is going to create, all of a sudden a huge GFC or a huge global crisis, in my humble opinion, because we've dealt with this many times in the past. The global financial system has dealt with it. And this is some context. Right now, it's at the 67th percentile. It's not like it's 100th percentile in context of history. Okay. Wage growth, all right, wage growth. So the 3-year average wage growth is masking the recent increase. It has increased, okay, it has increased. That's a good thing, right? That shows the economy is strong. But the 3-year average wage growth is really very, very terrible in Australia. And we know that the RBA wants 2 things to happen: inflation to be between 2 and 3%, underlying inflation to be between 2 and 3%, sustainably, and wage growth to be in that similar type of bracket as well. Wage growth just isn't there yet, and therefore they're not increasing interest rates until that happens. And then the last one is a big jump in rents, okay? So rents, I mean, there's a huge rental crisis in Australia right now. Rents are rising so quickly. I can tell you that in places like Bundaberg, rents are increasing $20 a month right now. Not a year, okay, a month. Okay, we've experienced this before. Last time we experienced such a huge shock in rental market tightness was just here around the GFC, or just after the GFC. And what you saw after 1 or 2 years here, this is obviously the rent graph, but what you saw in price growth terms is a huge boom starting in 2012 to 2013. So I'm not saying that's necessarily going to happen, but rental growth often, not always, often is a precursor or a precedent to sustained price growth in terms of housing. So right here, even though interest rates are rising, yes, that's the case, rents are rising too. So investors are still better off. Now, that was a bit of a deep dive, guys. I hope you stuck with me. The conclusion to all of this is the Australian housing boom going to finish now, or is it going to continue? You make up your own mind. But the picture that this all tells me is that it's not as doom and gloom as what people say when you look at things with history, and when you compare this boom or the time we're in versus the last boom, 2013 to 17, things are almost as good as what they were back then. Okay, so I don't think this boom will finish anytime soon. I've said it before, booms normally go for 2 to 4 years. We're about a year and a half, 2 years into this one, but I don't think the price growth will be as sustained in the future. And the areas that the boom will occur have pivoted, have shifted away from Sydney, Melbourne, and even to some extent Brisbane now to the other capital cities, especially Adelaide, especially Perth, which I've been talking about for almost 12 months or more, and also to regional areas. Okay, so should you buy now or not, or wait? Buy now, but make sure you pick the right suburb, the best property within that suburb as well. There's plenty of money to be made. Of course, we're investing for the long term, but we want short-term results as well. My name's PK, and if you want to take this sort of analysis further, if you really want to get educated, drill down to specific suburbs, specific properties, understand the economics of that suburb, the economics of that LGA, and really not just take a chance with some random buyer's agent or hotspot reports or anything. Actually learn this stuff. I'll leave a link below. Learn it for free. Start at least on my Facebook group, 14,000 people there now, and also the podcast. And if you want to level up, I'll leave a link below to the Property Investment Accelerator. But really, guys, I just want you to educate yourself, because I find it really enjoyable to talk about these things, and I hope you find it just as enjoyable to learn about them. Hit the subscribe button, give it a thumbs up, and I'll see you next time. My name's PK. Catch you later. Bye.